All right, this is the week of another Fed meeting, and we're going to learn, maybe get more clues as to when later this year the Federal Reserve is going to hike interest rates. The betting seems to be in September, and it would be by just a teeny bit, maybe a quarter point if that, but it would reverse what has been essentially almost a decade now, where rates have been staying constantly the same. But to hear this next fellow tell it, too late, guys. The Fed is already creating a bubble by not having raised interest rates sooner, and getting out of it is going to be a hell of a big deal. Tim Kane joins us right now. He is the former economist to the House Joint Economic Committee. Tim, very good to have you. So your view is too late, right?
Well, the data says it's too late, Neil. I think last week on Thursday when the jobless claims were reported, they're reported every Thursday, but everybody was shocked. They seem like these historic lows. They haven't been this low in 40 years.
Right.
And I kind of felt like everyone was late to the party, because if you look at it relative to, say, the size of the labor force, it's never been this low, right? It wasn't this low in the 80s, wasn't this low in the 90s, during all the boom times of the past. So the economy is giving signs that it's overheating right now.
All right. Now, there are others who argue with your interpretation of the economy, and they point to, Neil,
I lost your audio.
Okay, then I don't know what to do. I'll just wait. Can we fix his audio? What I will raise is, while we're trying to fix that, guys, is this idea that the contrary to argument. Can you hear me, Tim? No, we can't. I'm gonna hit Connell with this, because he's up there now and he can hear me. But Connell, one of the things that we've heard, Tim, in this explanation, Tim, if you can hear me now, maybe not. We hope to get it.
I'm back.
Oh, good. All right. Well, Connell, you stay there. Don't move. Tim, the argument is that we've had other economic data that shows that things aren't so hot and heavy. The new home sales that came out, and it wasn't so robust, and that, some surveys come out and they're not so great. So that you're right, the preponderance of the data is strong, but it's not all strong. And furthermore, inflation is not all that much of a worry. What do you say to that?
You're right. These things come up later. I'm looking for a broad measure. And maybe one of those is GDP, right? So it's not as hot as you think it should be. But GDP's never been this big before, right? $17.7 trillion. Unemployment insurance claims are one of the fundamental trackers of recessions. And right now it's saying we're about as far away from recession as we can be.
Yeah, but they vary a lot, right? They vary a lot
recession.
Week to week. Now, I know that the trend is certainly, to your point, been the economy's friend. But I guess what the Fed worries about as much as how it might rattle the markets. What do you think of that as a priority?
Yeah, the Fed was so gradual, though, Neil. Remember, in how they raised rates under Greenspan after 2004? It was always a quarter point, nice and steady. Well, we look back now, and that was too slow, right? They kept that mortgage bubble inflating years after they should have put a halt to it. So
when should they have done this, Tim? If they did, obviously they're going to do something later this year, we're told. But you argue they should have been doing this when?
Yeah, I think at a minimum should have been in January this year, right? Wow. So I would probably go back a year. Try a quarter point, Neil, and see if the world falls apart or if earpieces fall out, something like that. Try a quarter point. And they could have done that and then been steady. Instead, now they're going to set themselves up to have to ramp up and basically not let off the not let off the brakes.
No, one thing I do understand the conundrum they're in is that they've been trying to telegraph that whatever rate hike they have will be gradual. Not that it would be one and done, but that it would be one and we'll wait to see if we're done. In other words, this expectation that rates would rise every 6 weeks at a Fed meeting, that might not be the case. What do you make of that?
Yeah, I think they've given Janet Yellen has reduced the amount of wiggle room she has, and unnecessarily. So this is the first indicator. Actually, it's the second, right? We've been debating the unemployment rate for years now. That, gee, is it really this low? And look, so you've got the unemployment rate, you've got jobless claims, you've got pretty steady Eddie on the growth rate. At least let's return to normalcy. And we're still, we've got rates as low as possible. To me, it's really overkill at this point. It's way too much stimulus.
All right. Thank you, my friend. Very good having you.